Most major indices are down year over year, and the Federal Reserve has been increasing interest rates for quite a while now. But the best investors, such as Warren Buffett, whose strategy we'll discuss in this video, Fed hasn't stopped tightening financial conditions yet, despite the turmoil resulting from the Silicon Valley bank collapse and the recent shakeup of regional banks. It is important to note that the last time we had similar interest rate hikes, the economy went into a deep recession. Unfortunately, this is the economic reality every investor has to face these days, and the outlook is not better with the Federal Reserve anticipating higher rates going forward. Now, one may ask, what is the effect of increased interest rates on the economy? Apart from decrease in inflation, which is the reason for the interest rate hike in the first place, there are also other far-reaching effects increased rates have on the economy, such as 1. Higher costs of borrowing, 2. Reduced consumer spending. Now, for the investor, this means 3 things. 1. Bond prices go down, making them more attractive. 2. Higher returns on savings, leading to more of that type of behavior. 3. Stocks taking a hit because they, having risk by nature, now have to compete with higher risk-free savings rates. So, how do we invest in this situation, which is the reality for every investor in 2023? In this video, we will turn to some age-old advice from the Oracle of Omaha, Warren Buffett. Warren Buffett is the world's most successful investor, and his algorithm for picking stocks can be summarized in 3 steps. 1. Identify companies with strong and enduring competitive advantages, moats, and make sure to understand them well. 2. Buy in heavily for an attractive price when the economics of that business are strong. 3. Hold your investment for the long term. Now, Buffett's approach to investing looks simple, but beyond the 3 steps, one important component of his investment strategy is temperament.
Occasionally, Berkshire gets a chance to do something, and it's not because we're smart. It's because the only thing I'd say we qualify on, and sometimes I wonder about that, but I think we're sane, and that's the main requirement in this business.
In this regard, Buffett stated in his 1996 letter to Berkshire Hathaway investors, you should entirely avoid owning stock if a crashing market would lead you to panic and sell. In that letter, he also stated that selling fine businesses on scary news is usually a bad decision. And to buttress this point, he told the story of Robert Woodruff, the business genius who built Coca-Cola over many decades and owned a huge position in the company. Woodruff was once asked when it might be a good time to sell Coke stock. He had a simple answer: I don't know. I've never sold any. Buffett's explanation makes it clear that one might buy the right stocks with the right strategy, but lose it all with the wrong temperament. He also further explains what he calls the 3 philosophical benchmarks in approaching the market, which includes your attitude towards the market, your margin of safety, and viewing stocks as businesses.
There's 3 important aspects to it. One is your attitude toward the stock market. That's covered in Chapter 8 of The Intelligent Investor. I mean, if you've got that attitude toward the market, you start ahead of 99% of all people who are operating in the market, so you have an enormous advantage. Second principle is the margin of safety, which again gives you an enormous edge and actually has applicability far beyond just the investment world. And then the third is just looking at stocks as businesses, which gives you an entirely different view than most people that are in the market. And with those 3 sort of philosophical benchmarks, the exact evaluation technique you use is not really that important, because you're not going to go way off the track, whether you use Walter's approach or Walter Schloss's or mine or whatever.
For those who do not have the patience to deal with the ups and downs of the market, such as we are experiencing in 2023, Buffett recommends passive investment. So, what passive investment does Warren Buffett recommend? Well, Buffett's top pick is buying index funds. According to the Oracle of Omaha, all you have to do to invest in index funds is believe that America and American businesses will do well in the long run.
So this time I went back, actually to 1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats, we've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776. And that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
In his 1996 letter to Berkshire investors, Warren Buffett suggests that for most investors, the best way to own common stocks is through an index fund that charges minimal fees. He believes that those who follow this path are sure to beat the net results delivered by the great majority of investment professionals. But the big question here is, how much does Buffett believe in investing in index funds? Well, he sure believes in it enough to give the same advice to NBA star LeBron James.
My first question would be, what should I invest in next? Can I have some tips?
I think somebody like LeBron, and we've talked about it, but actually if through the rest of his career and beyond in terms of earning power then, just making monthly investments in a low-cost index fund makes a lot of sense. I think that somebody in his position ought to have a significant cash reserve at whatever makes him comfortable. And then beyond that, owning a piece of America, a diversified piece, bought over time, held for 30 or 40 years, it's bound to do well. And the income will go up over the years, and there's really nothing to worry about.
As far as the Oracle is concerned, investing in index funds is equivalent to owning a diversified piece of America for a long period of time. Quite impressive. Beyond the investment advice to LeBron, Buffett believes that the hedge fund industry charges exorbitant fees that the fund's performance historically can't justify. And so it's not surprising that investing in low fees index over time tends to yield more profit than owning a portfolio with a hedge fund manager. In 2008, Buffett issued a challenge stating that including fees, costs, and expenses, an S&P 500 index fund will outperform a hand-picked portfolio of hedge funds over 10 years. The bet was for $1 million, and Protégé Partners LLC, a hedge fund outfit, accepted the challenge. By the end of 2016, Buffett's index fund bet had gained 7.1% per year, or $854,000 in total, compared to 2.2% per year for Protégé's picks, just $220,000 in total. The index fund Buffett used for the wager was Vanguard S&P 500 Admiral Fund, while the fund of funds has not been publicly named. Whatever the case, Ted Sides, Protégé's co-founder, conceded defeat in a Bloomberg op-ed where he stated that, for all intents and purposes, the game is over. I lost. Buffett's little wager is clear proof that investing in index funds, such as the S&P 500, over time produces positive yields, even better than hedge funds. Applying this investment strategy over time by dollar-cost averaging a part of your income can yield great results with enough patience. By saving and investing regularly, you are buying stocks at different prices over time, which reduces the risk of poor market timing.